In business, leadership usually faces a strict compromise. You either burn cash to acquire users at lightning speed, or you slash spending to turn a profit, sacrificing your growth in the process. But what happens when a business refuses to make that compromise? What if a financial institution could scale its user base aggressively while simultaneously printing net income? That brings us to Nu Holdings, a digital banking platform that has effectively dismantled the traditional trade-off between expansion and efficiency. Their recent financial performance suggests that the accepted speed limits for scaling a fintech company might be entirely wrong. Nu functions as a digital compounding engine, where individual customers generate more value for the bank the longer they remain in its ecosystem. We can measure this using a metric called ARPAC, or Average Monthly Revenue Per Active Customer. This tracks the amount of money a single user brings in every 30 days. For customers who joined in January 2021, their initial activity generated an average of $11.20 a month. As they adopt more products like credit cards, their monthly contribution grows. Today, those mature cohorts generate $26 per month. That organic doubling of revenue per user allows Nu to fuel high-speed expansion with its own cash flow, avoiding the massive marketing burn that normally drains growing tech startups. To see how this engine performs at scale, we need to look at the financial data reported between the first quarters of 2024 and 2025. This chart shows Nu's top-line revenue climb. In Q1 2024, they posted $2.73 billion. By Q1 2025, that figure hit $3.24 billion. Even at this scale, they are maintaining year-over-year growth rates between 40 and 61%. Normally, tech companies expanding by 40% a year bleed cash to sustain velocity. Nu is not. Their annualized return on equity, measuring how efficiently a company generates profit from shareholder investments, consistently hit between 27 and 33% over the past year. These high return rates are being achieved while the company holds significant excess capital in reserve. A 40% growth rate paired with a 30% return on equity represents a level of operational efficiency that exceeds typical industry benchmarks. Of course, numbers on a page abstract the physical reality of what Nu is managing. The scale of their operations requires deep integration with the global financial markets. They are orchestrating investor relations across multiple continents, maintaining synchronized financial disclosures and live earnings calls in both English and Portuguese to serve a massive international base. CEO David Velez and CFO Guilherme Lago have explicitly stated their intent to maintain this profitability momentum, signaling strong confidence in their forward-looking models. But those models carry inherent risks. As outlined in their regulatory filings, their estimates rely on forward-looking assumptions and complex market data, which are always vulnerable to sudden economic shifts. When a financial base grows this large and this fast, it creates a massive surface area for macroeconomic headwinds to strike. This brings Nu to a fascinating mathematical crossroads. They are now colliding with the law of large numbers. The bull case is driven by raw cash generation. With mature cohorts providing a stable $26 a month per user, Nu is clearing over $600 million in quarterly net income. The bear case focuses on velocity. If you look closely at the year-over-year revenue growth, you'll see a distinct deceleration, dropping from a peak of 61% down to 40% in the most recent quarter. At this size, every additional percentage point of growth requires hundreds of millions in new revenue. The law of large numbers suggests that even a perfectly functioning engine will eventually see its relative velocity slow. The compounding engine has proven it works, but Nu is entering a new phase of its life cycle, where its own scale is the biggest hurdle to keeping that growth percentage high. What do you think? Can Nu continue to defy the typical constraints of digital banking, or is a broader slowdown mathematically inevitable? Let us know your thoughts in the comments. And make sure to subscribe to the channel for more data-driven breakdowns of global businesses. Remember, this video is strictly educational. It is not financial advice. Always do your own research before making any investment decisions.